Welcome to The Explainer. I'm absolutely thrilled you're here with us, because today we're unpacking what is easily one of the wildest, most fascinating market dynamics of the entire year. We are right in the middle of this incredible clash between massive macroeconomic storms, soaring inflation, heavy geopolitical tensions, interest rate anxieties, and on the flip side, an absolutely rock-solid market foundation that's just built on massive corporate earnings. It's a complete paradox. Honestly, it's enough to give traditional economists a total headache. But understanding how these two massive forces are colliding right now, that is absolutely crucial for making sense of where the global economy is heading next. Okay, let's dive into this. Our roadmap for today. Number 1, the macro inflation storm. 2, how earnings keep markets afloat. 3, spotlights on defense and AI. 4, crypto prices versus adoption. And 5, the data to watch next. So here is the ultimate question of the week. Why on earth is the market green when inflation is soaring? Just think about the landscape for a second. We've got rising inflation, the Federal Reserve openly talking about rate hikes, and active geopolitical conflicts. By every traditional economic textbook out there, the market should be deeply in the red right now, just panicking under the pressure. And yet, despite all of that noise, the S&P 500 actually ended the month of May in the green. It is a stunning display of resilience. But to really grasp why, we first have to measure the sheer size of the storm we're facing.
That brings us right into Section 1, the macro inflation storm. 3.8%. Wow. That is the number that is literally everyone on Wall Street sweating right now. April's headline PCE, which is the Personal Consumption Expenditures Index, essentially the Fed's absolute favorite inflation gauge, hit 3.8%. That is the hottest inflation reading we've had since way back in May 2023. So inflation isn't just failing to cool down, it's proving to be incredibly stubborn and sticky. Now, you really have to pair that 3.8% inflation print with our broader growth data to see the whole picture. Q1 GDP was just recently revised downward to an annualized rate of 1.6%. So when you combine slowing economic growth with rising inflation, that flashes a massive, glaring stagflation warning signal for the whole economy. The Federal Reserve is suddenly boxed into a total corner here. If they cut rates to stimulate growth, well, inflation just accelerates. But if they raise rates to fight the inflation, the economy slows down even more. It's a brutal spot to be in. And the timing of all this data hitting the wire was just unbelievable. On one single Thursday, the market absorbed two seismic forces at the exact same time. On one hand, that hot 3.8% PCE data dropped, which immediately spiked rate expectations and put heavy pressure on the market. But on that exact same day, reports came out regarding a tentative U.S.-Iran peace agreement brokered by President Trump. Now, while that deal hasn't been officially signed or finalized, just the mere prospect of peace caused oil prices to drop significantly, which actually provides immediate inflation relief. So you literally had these two massive macroeconomic events canceling each other out in real time, leaving us with a perfectly flat day in the markets. But beneath that calm, flat surface, the Federal Reserve is quietly getting very aggressive. The latest FOMC minutes revealed that a majority of Fed officials are actually totally open to rate hikes if this inflation doesn't cool off. This actually resulted in a 4-dissent vote, which makes it the most divisive Fed meeting since 1992. The translation here is pretty clear. If inflation doesn't behave, the Fed is ready to pull easy money right off the table and put rate hikes back in the game. Incoming Fed Chair Warsh is inheriting a deeply divided committee, which makes his upcoming June 16th decision an absolute powder keg.
All right, moving to Section 2, earnings keep markets afloat.
So if the macro weather is really that terrible, how is the market still standing? Well, get a load of this. The S&P 500 closed May up 4.6% year-to-date. That is the best start to a year since 2023. The market is explicitly telling us that right now, underlying corporate earnings simply matter way more than the macroeconomic headwinds. The foundation of these companies is so incredibly strong that it's absorbing the shock of inflation and geopolitical stress without even cracking. The absolutely crucial point here is understanding exactly what makes up this foundation. The macro environment is a massive headwind, for sure. But look at these corporate micro tailwinds. NVIDIA just printed an $81.6 billion quarter, and they guided for $91 billion next quarter. Walmart, which gives us a perfect read on the everyday consumer, just posted 4.1% comparable sales growth, and Microsoft saw its Azure cloud business grow by a staggering 40%. These aren't just solid numbers. These are concrete, fundamental business realities that are holding the entire financial structure up while the storm rages on outside. Let's transition to Section 3, spotlights on defense and AI. let's make this super tangible and look at two specific companies that brilliantly illustrate how strong micro fundamentals can completely override macro fears. First up, we have Parker-Hannifin. Now, most people hear that name and think, just a boring traditional industrial company making factory equipment. But actually, scratch that. They have quietly transformed into one of the most critical players in the entire AI revolution. Think about it. AI data centers generate massive amounts of heat, and they require direct liquid cooling to function. Well, Parker-Hannifin makes the dominant thermal management hardware to do exactly that. Add to that their brand new $2.55 billion acquisition of CICR to expand their defense capabilities, a record $8.4 billion aerospace backlog, and 69 straight years of dividend increases. This is a company generating its own massive internal momentum, totally ignoring the Fed's interest rate debates.
We are seeing a really similar story play out with Qualcomm. Yes, the stock pulled back recently mainly because hot inflation fears cause multiples to compress for tech stocks. That's just the macro weather acting on the share price. But look at the actual business itself. They just hit a $1.33 billion record in automotive revenue. They're aggressively expanding their custom silicon deals for hyperscaler data centers. Regardless of what the Fed decides to do with interest rates, Qualcomm's core business is expanding rapidly. They are navigating those short-term headwinds and perfectly positioning themselves for a massive catalyst at their June 24th Investor Day.
Okay, moving on to Section 4, crypto prices versus adoption. This exact same dynamic, the storm of macro fears versus the foundation of fundamental growth, is playing out in the digital asset space right before our eyes. If you only look at the short-term price action, yeah, crypto had a rough week. Bitcoin slumped to a 6-week low, dipping below $73,000, which was heavily driven by $1.3 billion in ETP outflows. That's institutional money de-risking ahead of a potentially hawkish Fed meeting. But contrast that short-term slump with the massive long-term infrastructure being built out right now. Paxos just became an SEC-approved clearing agency, which means blockchain settlement is now formally recognized as legitimate market infrastructure. On top of that, the CME just launched 24/7 crypto trading for institutions. The adults in traditional finance are quietly building the plumbing, while retail traders panic over the weekly price action.
What we are really witnessing is traditional finance furiously packaging crypto into familiar, regulated structures. Get this. BlackRock is preparing a brand new ETF that will literally sell covered calls to generate monthly yield from Bitcoin's volatility. They are essentially creating an income product for retirees out of crypto. Fidelity just tapped Chainlink to provide the vital data infrastructure for its new tokenized funds. And over in Washington, the Clarity Act is grinding out the exact legal definitions of how stablecoins can generate yield compared to traditional bank deposits. The plumbing of the entire global financial system is literally being rewired to integrate these assets. So the crucial takeaway here is captured perfectly in a recent quote from Fidelity Digital Assets. They're signaling that the mathematical reality of Bitcoin's supply cap is violently colliding with institutional demand. When you have giant corporations and massive asset managers absorbing Bitcoin at a rate that far outpaces the roughly 450 new coins mined every single day, scarcity isn't just a fun, theoretical concept anymore. It is a mathematical certainty.
Finally, Section 5, the data to watch next. With all of this incredible structural build-out happening beneath the surface, what are the actual triggers that will move markets next? Well, here is your exact roadmap for the week ahead. Monday brings the ISM Manufacturing PMI. You're going to want to pay very close attention to the prices paid sub-index, because if manufacturers are paying more for materials right now, that inflation will inevitably reach everyday consumers. Wednesday gives us a double feature with ADP payrolls and the ISM Services PMI, which covers a whopping 80% of the U.S. economy. But everything, and I mean everything, leads to Friday, the May jobs report. This is the absolute final piece of major macroeconomic data before the new Fed chair takes his very first massive interest rate decision.
And that leaves us with one final provocative question to wrap up this explainer. If Friday's jobs data comes in blistering hot alongside that stubborn 3.8% inflation reading we talked about, does the stagflation trap finally snap shut, forcing the Fed to shock the market with a rate hike? Or if the labor market cools just enough, will it prove that this market's incredible earnings-based resilience was entirely justified all along? We are going to have to keep a very close eye on the data this week to find out. Thanks so much for joining us, and we will catch you next time to break it all down.